you have to understand this model to understand what your financial model. So my question was, since we said we completed that, do you understand what the management model, the things on there, what's being computed? About depreciation. Right. We'll talk about depreciation. Loss of value is a physical or tangible asset. So what type of asset is this? Current or non-current? Right. This category of assets we're talking about are non-current assets, right? And in some literature, we also call these what type of assets. Have you come across another term for these types of assets? Fixed assets, yes, that's what the former term was, were fixed assets, yes? And one other term have you come across? Any other terms for these types of assets? Capital assets. Maybe a term you come across in your reading.
It's like the capex, when the expenses also called
Capex, yes, yeah. This is part of
Yeah.
capex, yes. Right. And so this loss of value, what is that a function of? Do you know what that's a function of? Right, this loss of value is based on what?
The ability to contribute, like machineries. The more we use it, it
Yes,
loses the
right,
ability.
loss of value, exactly. Age and use.
Yeah.
Age and use. Right. Not based on style, not based on obsolescence or anything like that. Okay? And it's treated as a cost. Right. Since I say it's treated as a cost, is it a cost? Or why do we treat depreciation as a cost?
Because of the loss of value.
Because
It's
of
not the
loss of-
same as it was in the year 1.
Right.
In the year 5, it will not be the same.
Okay. So who do we pay depreciation to then? If it's a cost, who do we pay depreciation to?
Cost to the company.
Yeah, it's a cost to the company, right? Because the company then eventually has to replace the asset,
Yeah.
right? Right.
It's an investment for the future.
Right. So why do we, in order to do that, why does it have to be treated as a cost?
The replacement value.
What's the purpose of a selling price?
consider all the cost and expected revenue.
Right. The purpose of the selling price is to cover all costs, right?
Yeah.
Like you said, cover all costs. And give the profit we want.
Yeah.
Right? So therefore, we have to treat depreciation as a cost. So our selling prices are set properly. So we recover all of our costs. Otherwise, to replace our assets, they come out of profit. Then that's not profit. Right? Profit isn't used to pay our costs. Right? So therefore, we have to treat depreciation as a cost. So when is depreciation accurate?
What do you mean when is accurate? Meaning when should
Correct.
we
When is depreciation correct? When can you determine what the actual depreciation was or should have been or whatever? When is the depreciation on the asset correct? Accurate.
It depends on the life cycle of the assets, right?
Exactly. So only at the end of the asset's life. Right? So everything prior to that, in the end of the asset's life, when we get rid of the asset, stop using the asset, right? We terminate the asset. That's the only time. Because oftentimes we'll buy an asset and say, we're going to use this for 4 years, right? That's our plan, right? I'm going to buy this car. I'm going to drive this car. Every 4 years, I'm going to get a new car, right? Could be. But then at the end of the 4 years, you never had a problem with this car or anything like that. So you said, nah, I'm going to keep it and drive it another couple of years, right? The depreciation then now changes of what you should have been charging, right? You change it, right? So treat it as a cost, only accurate at the end of the asset's life. All right, and now there's several ways to compute depreciation. Right? So straight line depreciation. Original cost minus the salvage value of the asset divided by the asset's useful life. Right? So based on our definitions and our understanding of depreciation, right? Useful life is an estimate. Salvage value is an estimate. And the original cost is the only actual piece of information that we have. Everything else is an estimate. Right? original cost is more than just the purchase price of the asset. So depending on the asset, right, original cost equals the purchase price plus any installation charges plus any any training costs.
These are training costs, installation charges. We are only adding it on the first year, or we are segregating it in all of its life cycle.
This is all part of original costs.
Yeah. So when I'm doing that, I'm gonna do it only once because
Well, you
installation
only have
charges
one original
Yeah.
cost.
at the beginning of the life of the asset.
Right, you only have one original cost. You're gonna buy whatever assets you're buying, but then you have to
The same or
remodel your facility to, that's part of train your staff to use it, right? So original costs are all of these things. So any additional, any cost to make the asset useful.
Transportation will also come on this.
If you pay the transportation fees to get it, yes, right? Any insurance while in transportation, any additional charges to insurance on this asset, yes? Yep, all of that's part of original cost. Any cost that the company incurs to make the asset useful, to be able to put the asset in a useful position for employees to utilize. So therefore, training, all of that, right, all of that. Remodeling, if you have to remodel your facility.
Albert, just
Yes,
laptop is a physical, tangible asset. If I bought it for the company,
yes,
and I understand all of this cost, but then let's say down the line it has, let's say, 5 years of warranty that I can use, and down the line there will be like upgradation, something. So that also goes on original cost.
what,
Let's say
upgrade
if I
5 years
upgrade
from
the-
now? No,
No, not 5 years. In between five, let's say third year, I upgrade the RAM, the hard drive or something, or I install a new battery.
no, original cost is just like it says. What are you paying for that asset now to
Now,
make that
okay.
asset useful now? Right? It's only that, right? So, any cost to make the asset useful now.
Sure. Did you get what I asked? So after 3 years, if I increase the RAM, then that cost goes on that year,
Right?
not the year.
Not the preceding years.
Year.
Right. So the only actual price in the computation that you know are these things. You're paying for what it takes to make it useful. What you expect to sell it for at the end of a useful life is an estimate on your part, right? How long you're going to use it is an estimate on your part. Right? And then one thing we have to know, you realize, right, that useful life doesn't have to be years. It's, right? Useful life, we're going to use it for 7 years. Right? For example, we buy a car at 90,000. Let's say, buy a car. We expect to sell that car for 6,000 at the end of its useful life, and we're going to utilize that. Let's say 6 years. Right? So what's that? 84,000 divided by 6. That's not very good, easy math, right? Oh, yeah, it is. Equals right? 14,000 per year, right? My math right? That's 14,000 per year, right? Depreciation, right? If that's for a year, so we get 14,000 per year depreciation. But it doesn't have to be, right? We bought a car and we say we're going to drive this car instead of in years, we're going to drive this car 100,000 miles. Right? So it'll be 84,000 divided by 100,000 miles. Right? What's that, 8 cents per mile? Is my math right? See if my math is right. Is that 8 cents per mile depreciation that we would charge on that vehicle? So whatever period we're doing, we'll look to see how many miles was driven that period. So in that period, if we drove it 10,000 miles, 10,000 times 8 would be the amount of depreciation taken off in that period. Right? So it doesn't have to be years, it doesn't have to be miles. We bought a machine that does the same thing, and it could be in units, right? However many units we're going to use that machine to produce. And then we would get depreciation per unit. We'd look to see. Okay?
Albert, just another question.
Yes.
In a big company, like let's say a multinational company,
Yes.
there might be a lot of different divisions.
Yes.
Where the divisions might also sometimes do their management models, their financial models.
Yes.
And the company core also has their model.
Right.
So the depreciation will come from the core company finance team, and all the other division has to maintain that, even if that particular division is not using that particular asset. Is that
I have to answer you like this. Are we talking management or are we talking financial
financial model? Financial model.
So on the financial model, then the company, based on categories of assets,
Okay.
they will dictate the method of depreciation to use.
Okay.
And then chances are it'll be the same method that wherever they file their taxes, that national government has said this is how you
For
do
this service,
depreciation for this class of asset.
Okay.
Right. Yeah. But management-wise, each division, SBU, they can do what makes more sense for them to do. Yeah, if that makes sense. Yeah. Everybody clear? So no one direct answer,
Yeah. I'm
unfortunately.
just trying to understand.
Yeah, but that's the game. So management-wise, in our division, our region, we may do this. Another division region does something else.
So that also means there is no uniformity in the number, right?
No, management-wise, this is inside the company. There's uniformity because those inside the company understand why they're doing what they're doing, right? So there's uniformity inside. But for us coming out, that's why then the company would say, for these classes of assets, this is how you do it. So we don't know the internal rationale, so we can evaluate consistently. Yeah. Yeah. Make sense?
Can we have a break?
Yes. Yep. Okay? Because straight line depreciation, right? Most common method because it's the easiest method. Right? And we talked about, well, I'll see. We'll talk about, yeah. Okay, let's take, take 15, come back at 9:30. That's a little more. Does to the total amount of depreciation.
Eventually it gets reduced.
Is the total amount of depreciation that's going to be taken on the asset changed as opposed to the total amount if we were doing it the straight line method? right, in our straight line example, right? We computed depreciation is gonna be 14,000 a year for 6 years, right? So in total, that was 84,000 of depreciation, right? Now we're gonna, instead of doing straight line, we're gonna apply an accelerated method, which means we're gonna take more depreciation in the asset's early years than the later years. So do you think, what does that do to the total amount of depreciation? Straight line, we're gonna take a total amount of depreciation of 84,000.
Straight line is the depreciation rate is always the same
Same in the every year.
every year,
Yeah.
and accelerator is higher in the early years.
Right. My question said,
What is the
straight line method, right, was 14,000 per year.
Yeah.
6 years.
Yeah.
Right? Total depreciation, 84,000. If we do this, does this amount of total depreciation change?
No, it's just how we segregate per year that changes.
Right. The total amount of depreciation doesn't change. Right? We'll still be taking roughly 84,000 of depreciation.
Does it depends on the type of the physical assets that which model I'm gonna go with, straight line or accelerate?
Well,
Yeah.
yeah,
Depends on the type of the asset.
type of asset?
Like type of the tangible asset on the depreciation
Is it
model.
the type of asset or
The kind of-
depreciation, right? We have different types or categories of assets.
Yeah, yeah.
Categories or original cost, right? Which one would you want to do this on? Because depreciation is giving you your value back, right? So which asset would you want to have an accelerated method on? Is it by type or by cost?
It's by the type, right?
What was the question again?
The question is, I'm trying to think. No, okay. My question was, when would you want to apply this type of method? And you have two choices. Is it based on the type of or category of asset that you want to do this, or is it based on the cost of the asset?
It can be both, but looking at the definition, maybe it's based on the original cost. But I'm trying to segregate the different type of physical assets. Let's say if it's a factory machinery, obviously the earlier year the cost will be higher because the installation, the training, all of these things happen in the first year. So then it falls in the types or the categories. But original cost, like
But how the depreciation is charged more in early years than the later years?
Yeah. If we're charging it more in the earlier years, it means we're getting our money back sooner, right? So it's based on the cost. You want to apply this type of method based on the cost. The more expensive the asset, the sooner you want to recoup your value, right?
oh, okay.
Right?
Yeah, so based on the cost.
So the accelerating method is based on cost, right? Okay. So the first method we can talk about declining balance. Right, we can estimate then, say depreciation will be at a fixed rate of 10%. Or we could do this. In our method, we computed straight line depreciation of 14,000 per year, right? On an asset cost of 84,000, right? Yeah. 14 divided by 84, what percent is that? What percentage point is that? What percent?
17%.
17%? Okay, right. So, straight line tells us 17% depreciation. So if we assume then we have an asset, right, that costs 17% in our example, we're depreciating 84,000 times 17%, right? So year one, that equals how much? 84,000 times 17%, is that 14,000?
14,280. 84,000 into 17%. 14,280.
It's in, what is this?
14,280.
Oh, 14,280. Yeah, okay, yes? Right, so that's in period one, at 17%, we would take 14,280 worth of depreciation, right? So therefore then, at the end of year one, our book value of the asset, 84,000 minus 14,280, that equals what?
$69,720.
Okay, right? So then the second year, our book value is 69,720 times 17%. That equals what? You see where this is going, right? Declining, right?
Oh, you are.
Yeah.
11,852.4.
11,852. Okay. So book value 69,720 minus 11,852. That equals
57,867.
57,867.
Yeah.
Okay. Three. So year three, 57,867 times 17%.
9837.
But you get the picture.
Yes.
Accelerating, right? Accelerating depreciation, declining balance, right? You can see, right, by definition, more depreciation is charged in the early years than the later years. So you see, year one was 14,000, year two is only 11,000, year three is only 9,000, year four will be even less, right? Okay, declining balance, right? And the declining balance is based on the book value, because depreciation that's shown on the balance sheet is what? The depreciation that's shown on the balance sheet is the book value. That's what's on the balance sheet. Right? Balance sheet shows us the book value, right? What we carry the asset on our books as. Right? So book value equals original cost minus all accumulated depreciation, right? The period depreciation, where does this appear? Right. Balance sheet book value original cost minus all accumulated depreciation. So the period depreciation, what happens to that?
It goes to the financial model.
Yeah.
Total depreciation.
Right. The period depreciation we see on the income statement, right? Period depreciation on the income statement, right? It's subtracted out, right? Operating expenses plus depreciation and
Plus
amortization, right?
Yeah.
Subtracted out. And then where else do we see the period depreciation? That's cutting deep. We add it back in on the, we subtract the period depreciation out on the income statement, and we add it back in on the
Financial model.
cash flow statement, right? Because as you told me, right, we don't pay this cost to nobody, but we have to treat it as a cost, so we recover the amount that we need in our selling prices to replace the asset. So we're not using profit to replace the asset. So since we subtracted out on the income statement, we have to put it back on the cash flow statement because we don't pay it to anybody.
Like in income statement, it goes as expenses. And in
The
cash
period
flow,
depreciation is,
Yeah.
right? The period
in
depreciation.
the cash flow, it goes as it comes in.
Right, because the first category on the cash flow statement was operating activities. Your first entry was operating profit.
Yeah.
The next entry is depreciation,
Oh, yeah.
right? Look at the structure of the cash flow statement. Right? That's why I say we have to talk about all of these statements together because what we're doing, it works its way through.
It is not the cash or cost that goes outside, so we are just balancing it from
Exactly,
adding it.
exactly. Okay?
But it's still living with.
Alfred, I don't remember where did we get the 14,000 over there when we 14,000 divided by
Where do we
84?
get this?
Yeah. 84
We
was
said
my total
the straight
cost.
line example was we bought an asset, 90,000.
Okay.
We're gonna sell that asset for 6,000 at the end of its useful life, and we're gonna use it for 6 years. Right? 90 minus 6 is the 84. If you divide the 84 by 6, that equals the 14.
Yeah.
And then the 14, just because you were questioning where does, if I just pick one, where does it come from? So for example, you see what the percentage was, straight line, and then you can apply that percentage to the declining balance method, right? Which allows you then to, instead of only recovering 14,000 a year, you get a little more than that earlier, right? Okay, so starting, the beginning balance sheet at the beginning of period one would have shown 84,000, which was the book value of the asset on the balance sheet. We operate, we apply depreciation 14,280. The balance sheet that comes after that period would show a book value of 69,720. That period depreciation 14,280 goes to the income statement. So we cover our costs. And then since we subtracted it out on the income statement, we put it back on the cash flow statement because we didn't pay it to anybody. right? Confusing, but not confusing. Right? Are you still with me? Yes, because it can be. Right? Right. So that's a declining balance method.
Balance.
Right.
And also we need to add in
Another version is just the double declining balance. Right? Another common accelerated method is the double declining balance, where however you want, you get your percentage, right? And as the name implies, 17%, double declining, we times it by 2, so that equals 34%, so you can take even more earlier, and then instead of applying 17% each period, we'll apply 34%, right? You get the picture, and then it will take even more, right? You get the picture. Right? So, accelerated, declining balance, double declining balance. Right?
Albert, like, why do we use this method? Where do we use this
Because you bought a very expensive asset. So you want to recover your depreciation earlier, right? If you do that as compared to the straight line method of just recovering 14,000 per year, what does that do? Based on these two, you can hopefully visualize, right?
Yeah.
My profit is at one level if I only recover 14,000 per year. What happens to profit if I do an accelerated period? What happens to my profit?
True, the
Depreciation is higher, so profit is lower
lower, yeah.
because I bought an asset. If I use a double declining balance, profit is even lower because I'm recovering the value of that asset faster, right? Versus stretching it out. Right? And then cash flow statement, we put it back. The next, right, there was operating activities, and then we see investing activities, right? Investing activities, right? We see that purchase of that expensive asset, right there. So we understand why we're doing it, right? So we can see the investment then that was made into our capital assets. So income is lower here, so therefore our taxes are lower, but the net effect on the company is positive, right? Everybody good with that? And then there is one other accelerated method. called sum of years digits. Oh, I should have. You got your notes?
Yes.
I should be consistent. I should have notes consistency. And I think I'll do that so we stay consistent.
And every time we have to scan. Even after break again. What the fuck, man?
Did you check out?
Okay,
No.
accelerated
You
method.
have to check out after.
Another common accelerated method is sum of years digits, right? In our example, we were going to use this asset for 6 years, right? So the sum of years digits we reverse, right? So 6 years, 6, 5, 4, 3, 2, 1, right? So 6 and 5 is 11, and 4 is 15, and 3 is 18, and 2 is 20, and 1, that's 21, right? So that's the sum of years digits. Hence the name, right? The sum of the years digits is 21. And then so the digit, the depreciation amount, 6 divided by 21 is what percent? 6 divided by 21. Right? 6 divided by 21 equals
0.29.
29. Okay, we just go there. 29%. Okay. 5 divided by 21.
4%.
4%. Okay. 4 divided by 21.
19.
19. Okay, good. Okay, 3 divided by 21, right? 14%. That's
10.
2 divided by 21. 10%.
5%.
And then 1 divided by 21 equals 5%, right? And roughly that should total back to 100%, right? Right? So you see the percentages then that are charged each year, and then now, right, it's the percent times, right, it was 84, right, so this would be 29% times 84,000 in our example, right? And then that would be 84,000 minus our depreciation amount, right? The method of how to compute. Right, so 29% times 84 is
24,000.
24,000. It's 24,000. So our book value is 84,000 minus 24. Minus 24,000. So our book value is 60,000. Right? And then you take 24% times 60,000. And then go on and go on and go on. Right? Just like we did in the other declining balance summaries. Right? Then to compute the total amount of depreciation. Okay? Oh, no, wait a minute. Wait. No. This is sum of years digits. I'm sorry. The percentage is always off of the the cost of the asset. I'm sorry, it's not off of the book value, it's off of the asset in this method.
It is the cost of assets or?
Right, it's in this method, it's on the cost of the asset.
84,000 cost of assets is 90,000. 84,000 is
Yeah.
depreciable amount that we.
Right,
Yeah, but we deducted that
Right.
original cost.
we don't
That's right.
take depreciation on our salvage value. If you use the 90,000, that's the total cost of asset, which ignores salvage value.
Yeah,
So
after deducting that we are keeping.
then we're at 84, right? So to keep it
This is
simple,
After salvage.
do you have to do a salvage value? Do you have to estimate a salvage value?
For this one,
For any of them?
yes,
Why?
because we are taking the amount after.
Yeah, but I mean, this was an estimate, right? All of the only actual cost was this. That's an estimate. This is an estimate, right?
So when the.
We can estimate salvage value is 0,
Yeah.
right?
So, but when the question comes, there will be salvage value also will be given.
If there is one, yes, yeah, you'll be told, right? But we don't have to have a salvage value. We could use
Salvage value
right,
might be.
0, right? We're just going to junk it. We're not going to try to
But
sell
in
it.
this case, we considered 6,000 salvage value.
Right, so that's the depreciable amount is the 84,000.
Yeah. And at the end of the cycle, depreciation, that should add up with the value.
Yeah. You're just taking more in the earlier years. That's all.
So in straight line, it's a simple that we just use that formula. But for other accelerated methods, we are just using our depreciable amount as a main amount, not the original.
For a straight line, you're using the depreciable amount of 84.
What's
We
the
don't
value?
we don't depreciate the salvage value.
What's the perspective?
I'm saying that in a straight line, we will give an original cost and we will just use that formula, and the percent will be same in straight line. But in every other method, we do not use original cost, but we use the amount that we get after deducting salvage value. You know, in some
Right, but you're saying the same thing. Because how do you get the original cost minus the salvage value is the depreciable amount.
If there is no salvage value or if I'm not
right? If salvage value is zero, in all of the methods,
It
we would
is,
use original cost. Right? Right?
How did we consider the value? The 6 years value, uh, and that is the 6 years, the life cycle of the asset. And the value we had considered 6543.
We estimated in our method to be consistent, we were gonna use the asset for 6 years.
Yeah,
That's where 6 years
6 years.
comes from.
The value.
And then we switch it, right? 6 years, we're taking more earlier, so 6, 5, 4, 3, 2, 1 is just the number of years. That's why it's the sum of the years, digits. Right? But thank God, Excel will do, right? You have a document in Canvas that will talk about depreciation, right? Where you can build an Excel model and then get to the various ways to compute.
Is it inside financial accounting session 1 to 4?
Yes? Yep, it should be. Let me see. This document here, right? I just talked from this one, this document here. If you open that one up,
Yeah.
open this document,
Yeah.
you'll get an explanation of various methods. And then guidance about to set up your model in Excel to compute depreciation. So most of you, you have your management model and your financial model in the same workbook, right? So just go to another worksheet and then follow the guidance that's in this document to compute depreciation. So you get to compute depreciation by straight line method, declining balance method, some of use digits method, double declining balance method, variable declining balance method. So you'll get the 5 most common types of depreciation, but instead of computing by hand, utilize the function of Excel. Okay, and if you have questions about getting it done, ask. No, that's the document I just went through, explained, but it's the document before that. That one, yes.
Double declining is the same as double declining will be the same, just doubling the straight line value, right? Calculation is same.
So it gives you another explanation of the methods,
And
and then below that,
which will be
What is VDV?
example, how to set up an Excel sheet and then to
And what? We're going to VDV also? What is VDV?
the variable.
We discussed it.
No, because it's okay. You want year, right? Yes, enter. And then 0 through 8. Right, we're utilizing the asset for 8 years. So you want 0 through 8. All right, good. And then next to the 0, let's see, click on the FX, click on the function, right? And we want type depreciation. Yep, and then go. Right. Okay, so I just wanted to make sure, right? Everybody's there. She typed depreciation, she gets a drop-down menu, and then we'll start with SLN. SLN is straight lines. So select that. And you see, you select it and it tells you, returns a straight line depreciation of an asset for one period. Right? And what information do you need? Excel is telling you. Right? You see? You see that? Excel is telling you. You need the cost, the salvage value, and the life. Okay? You click OK. Right. But then in this cell here, escape out. You just want the title. Yeah, if you can move that down to line 1.
Oh, okay.
Okay. You're too fast. Wait, too fast. Too fast. Come out. So we know. On C5, type SLN so you know the methodology. Right? Good. Okay. Now come down to C6. Right. Now C6, we want straight line. It's FX. Right. And then you see when you open it up, you don't need to type depreciation because straight line was the last function you used.
Oh, okay.
So it's going to open up to the last function then that you use. Now click OK. Right. And so they want the cost. Right, so, okay, maybe I should put a cost. Select the cell with the purchase price cost, right? And then they want the salvage value, right? And then the estimated life. There we go. And now click OK. Right. And our example says the purchase price is 20,000 euro. Salvage value 4,000 euro. Estimated life is 8 years. Right. And you see then that it's telling you, right, because 20,000 purchase price, salvage value 4, depreciable amount 16, 16,000 divided by 8 is 2,000, right? So then now, right, if click on the cell that had the formula, right, in the formula, so you want dollar signs around each one of those, so you can just copy down. And everybody can fix their model for straight line.
My function is not showing depreciation.
Just type
You understand? She's taking
Can I escape out?
Okay, now the summation is 16,000.
Click
That is
on
because
the
4,000 was salvage value.
type SLN there, just the type, so you know what method
If this was not there,
you're enter.
this summation would have been
And then
20,000.
now on that cell there, click on the FX, right? And then in the formula bar, that's where you would type depreciation. Enter.
You want me to choose it higher? Oh. I put it here. Yes, I even in Sri Lanka I sold Panipuri.
Try, no, no.
I want to check tamarind if the same according to the tamarind.
What happens if you write?
I was jumping in Sri Lanka without any parents, friends, anybody, okay?
Okay, there you go. So you
So
have
if
to
you
write.
want to share something, find the person.
Okay, now type depreciation up in the cell.
Absolutely, I will. And I will write it. Doesn't even know how to do it. So I have to think of formula.
Sarah, do you want me to explain?
Yeah.
Yeah. No. No, I'm saying like I was in that situation without any help. That's what I meant.
But you don't need help for that situation.
I said I was already in that situation.
But people require a working problem. You have to direct it, you go to the next one and do the same thing, only take a different title. Right? Yeah, but did you write the sales to take? No. You go back to where you had the highlight.
Your in-laws have come, right?
But you need dollar signs by each one of the seals. No,
I thought they did for a
block the
while.
cells to copy. Click on the cell with your formula. Trying to see dollar sign B1, dollar sign B2, dollar sign B3. But it has to be by each cell. I can't advise you on it because I'm not familiar with your keyboard. You just, it has to be dollar sign B, dollar B1, dollar sign. Right, B1 has to be enclosed by dollar sign to lock the cell to copy. Put a dollar sign in front of it. Now, it goes over to the one, no, over to the one before the comma. Yeah, dollar sign. Yes. Now, you have to do the same for B2. Before and after. You have to do the same for before. Yeah. Now, you told yourself to always pull from the cells when you're doing copies. Now,
Why are not putting here?
you have the dollar sign on the first one. Compute depreciation for the period that's under your consideration.
Yeah.
You don't have to compute for all, as if you were doing it manually. You would have to do this manually, right? If we wanted, what is depreciation in period 7, we would just take the cell reference B12, and that would compute period 7, right? So that's what Excel is doing. You okay? And then, so the next one was SYD, sum of years digits. I don't know why I put it in this format. Sum of years digits, right? SYD, yes? Okay, everybody's here, right? To do the next one, SYD. Right? So in line with cell 1, yes? Right. And then we want to go to depreciation again. Right. And you see, okay, declining balance is what we used the last time, so that's why it comes up. So we want SYD. And then Excel explains to you what the method is, and explains to you what the what to look for, what you want to do. Sum of years digits, SYD. Per is period. No, but your period isn't.
I took 8 because now.
Then that should compute on period 8, not for
Okay.
period 1.
We are just telling the
Her
one
Excel uses period instead of year.
Yeah.
Right? I don't. Yours could use something else, right? So you can't just go by what her Excel is calling. Yeah, that's what I said. Last time everybody was just copying up here, but you really weren't paying attention to what your Excel was telling you.
Mine is getting for
Hmm? Per is period, right? Okay. Yeah.
we need to say it first year, right?
Yeah, well, there was nothing the matter with you computing 8, but you wouldn't put the total for year 8 up on period 1 line. Right? This is period 1 line.
And we need to log again.
Right? And then it's the same thing again, right? You lock the particular cells, and then you leave the period cell unlocked. Right? See, that's what you computed for period 13, right?
For some reason, my DB is like 9 euro less than 16,000. It's because of the fraction.
Yeah. So if you total here, if you put a sum on each one of these, then we can talk about that. So sum, yeah. Yeah.
Or is it like a little less DB?
Because in a declining balance method, you never actually get to 0. Right? You'll never actually get to 0. And then the next one is DDB, double declining balance. Now you got the hang of it now, right? Right? And there's the same.
What to sell it on factor?
Oh, it has become 0
Mm-hmm.
on the year 7.
There's 7 and 8. And then total.
That's because we are considering the cost in the earlier period
And
of
then
the.
do your sum, and then we'll see. And And you should notice, right, in the declining balance, we never actually get to zero, but in the double declining balance, we'll actually zero it out. Is everybody there? Right? Excel is working? Yes? Okay. Then the next one is VDB, variable declining balance. And you'll see this in a minute. VDB, right? Depreciation, any asset for any period, including partial periods, right? And then the start period is the next period that you want. No. You're starting in year one and you're ending in year one, right? Keep it simple, right? All right, we want to compute the depreciation for the periods we have. The start and end period is the same. Right?
Why is it 0?
I don't know, let's look at your formula. Right? Let's go back.
Formula equals to VDB.
Okay, like question, something doesn't look right? Learn Excel, so click here, help on this function, right? Something doesn't look right? So what can you do? You can click help on the function, and then it will describe and talk to you about the function you're trying to use so you can answer your questions, right? But I didn't see where you got the factor. Did it ask you for a factor?
No.
See, let's go back, right?
It asks factor in and
Oh, scroll down. Scroll down. You got a bar over here.
Oh, okay.
Okay, see?
Factor and no switch.
So the factor, right? If you, right, the factor wants to know, okay, on your variable declining balance, what factor? So we can have a factor of 4. Right, we had double declining, we're going to do double declining, right? Put in a factor of 4, right? That's what the factor is talking to us about, right? Right? But this is, I don't, Well, try the in period here. I want to compute by it. Change this to B, what is the last period? B14, right? No, B13. Try B13 there, see if we get a number. Okay, okay, now we get a number, okay? Let's see what we get, right? Factor of 4, click OK. But, okay, then this is confusing to me, right? Lock B13 because it would always be there.
Albert, there was another component here, says no switch, and it said switch to straight line depreciation when depreciation is greater than declining balance. False or omitted.
It's going to switch to straight line if straight line depreciation is greater than what the depreciation that this method calculated. Right. So you left it blank and you told them true, right? But let's play with this one. I don't use this one that often, so let's lock B13. Okay, you get, see if you what happens if you copy that down.
Yo.
Yeah. Yeah, but yeah, I don't get it. But I was going to try to show you, variable declining balance. I don't know. I couldn't get my Excel to work either. I couldn't figure that out. So, but that's why I say it's complicated in trying to explain to do it manually. But these are the methods: straight line, declining balance, sum of your digits, double declining balance. Right? And so you can see they all, no matter the method, they all are going to return roughly the same amount of depreciation. So just because you pick one method over the other, in total depreciation is not going to change, but how you earn that depreciation back changes. So